journey in your last two. I swim with tea when they turned in. The siren out to mute. And can land a pole that sunk he died.
Let's now bring everything together by comparing two different situations. In the first, an individual earns interest income personally. In the second, a corporation earns the same interest income. Although the tax process is different, the Canadian tax system is designed so that the overall result is approximately the same. Let's begin with the individual. Suppose an individual invests money in a savings account, GIC, or another interest-bearing investment. During the year, the investment earns $10,000 of interest income. Because the individual earned the income personally, the interest is reported directly on their personal income tax return, and personal income tax is paid on that amount. After paying tax, the remaining money belongs to the individual. Now let's look at the corporate scenario. Instead of investing personally, suppose the business owner leaves surplus cash inside the corporation. The corporation invests that money in the same type of interest-bearing investment and also earns $10,000 of interest income. However, unlike the individual, the corporation does not simply pay personal tax. Instead, the corporation is subject to the special corporate investment income tax rules. This means the corporation first pays a much higher amount of corporate tax on the interest income. At first glance, this makes it appear that the corporation is paying significantly more tax than the individual. Naturally, many people wonder, why does the corporation have to pay such a high amount of tax when the investment income is exactly the same? The answer lies in the tax integration system that we have been discussing throughout this chapter. The corporation pays a higher amount of tax initially because this is only the first step in the overall process. As we'll see in the next slides, part of this tax is refundable when dividends are paid to shareholders. So, while the two paths look very different, they are both designed to achieve the same overall objective. The important point to remember from this comparison is that interest income follows different tax paths depending on who earns it. An individual follows the personal tax system, while a corporation follows the corporate investment income tax system. Although the journey is different, both paths are intended to produce a fair and integrated tax outcome. Let's now follow the journey of interest income after it is earned inside a corporation. Understanding this flow is the key to understanding why the corporate investment income tax system works the way it does. Our example begins with a corporation investing surplus cash in an interest-bearing investment, such as a GIC or a bank account. During the year, the investment earns $10,000 of interest income. The first thing that happens is that the corporation pays corporate tax on that interest income. Unlike active business income, interest income is subject to a much higher initial corporate tax rate. This often surprises new students because the tax appears significantly higher than if the income had been earned personally. However, this is not the end of the story. A portion of the tax that the corporation pays is recorded in special refundable tax accounts. Think of these accounts as temporary tracking accounts. The corporation has already paid the tax, but some of it may be recovered later if certain conditions are met. Those conditions are met when the corporation distributes its after-tax profits to its shareholders in the form of dividends. Once a dividend is paid, the corporation may become entitled to a dividend refund. This allows part of the refundable tax that was previously paid to be returned to the corporation. At the same time, the shareholder reports the dividend on their personal income tax return and pays personal tax on the dividend received. When you look at the entire sequence from earning the interest income, paying the initial corporate tax, recording the refundable tax, paying the dividend, receiving the dividend refund, and finally paying personal tax, you can see that every step is connected. The important concept to remember is that the corporation pays a high amount of tax first, but it does not necessarily keep paying that full amount forever. Part of that tax is designed to come back through the dividend refund mechanism. This is how tax integration works in Canada. Instead of looking only at the initial corporate tax, you must follow the complete journey of the income all the way to the shareholder. Only then can you see the true overall tax result, which is designed to closely resemble the tax that would have been paid if the interest income had been earned personally in the first place. At this point, we can compare the two complete journeys and answer an important question. Does a corporation really pay more tax on interest income than an individual? If an individual earns interest income personally, the process is very straightforward. The individual invests their money, earns the interest income, reports it on their personal tax return, pays personal income tax, and keeps the remaining after-tax cash. When a corporation earns the same interest income, the process is longer. The corporation first earns the interest income, pays a high amount of corporate tax, records part of that tax in refundable tax accounts, pays dividends to its shareholders, receives a dividend refund, and finally the shareholder pays personal tax on the dividend received. At first glance, the corporate path appears much more expensive because the corporation pays a significantly higher amount of tax upfront. This often leads people to believe that earning investment income through a corporation results in much higher taxation. However, that conclusion is based on looking at only the first step. To understand the true tax result, you must look at the entire journey, not just the initial corporate tax payment. Once the corporation pays dividends, it becomes eligible for a dividend refund. At the same time, the shareholder pays personal tax on the dividends received. These additional steps are an essential part of Canada's tax integration system. When we combine the corporate tax and the shareholder's personal tax, the overall tax is designed to closely approximate the tax that would have been paid if the interest income had been earned personally from the beginning. This is why experienced tax professionals never focus only on the initial corporate tax. Instead, they always consider the combined effect of corporate tax, refundable tax accounts, dividend refunds, and shareholder taxation. A good habit for every tax preparer is to remember three simple ideas. First, don't judge the tax system by looking only at the initial corporate tax. Second, always remember that the refundable tax system is an important part of the calculation. And third, evaluate the combined corporate and personal taxes together, because that is how tax integration is designed to work. The most important takeaway from this example is that although a corporation initially pays much more tax on interest income, the refundable tax mechanism and the shareholder's personal tax work together so that the final overall tax result is intended to be very similar to the tax that would have been paid if the interest income had been earned personally.